Janice, how are you? You know what? I probably hibernated her for the winter.
Oh.
Last year probably is what happened. Here we go.
Well, we don't care about that guy, huh?
You are in.
Oh my gosh, look at all these names.
I know, right?
Good.
Yeah.
This is Carlene, my friend.
Carlene, it's so good to meet you. Will you please sign in?
Here?
Yes, please. And will you write Janice's name next to yours? So, Janice, we've got only one cooler this time, but there's beer on one side or alcohol on one side, non-alcohol on the other. And all the snacks are up there, and we're going to get started any second.
Okay, sounds good.
In fact, I was just about to start, and then I saw you ladies walk in. I wanted to say hello.
We don't need any handout.
No, the feedback forms are on there. Sam, welcome back. This is just two-sided paper. So, well, AVID investors, I cannot believe we are all back in the same room together. Welcome back. For those of you who've been coming for a long time, you all know the drill, but we do have some new faces here. So getting it started, we'll just say, get up and get a beverage anytime, get a snack anytime. This is your club. Come late, leave early. Hopefully you'll get the absolute most out of it. But most importantly, thanks for coming back. Thanks for sticking with us. It's been a long year. Where did I put the slide changer? And other future things that will be interesting this first time back. Does anyone see a slide changer? Shane, do you see a slide changer? Did I put it back in here? Huh. Oh, perfect. Okay, new members, who's here for the first time today? Welcome, tell us your name. What brought you here?
Janice.
Welcome.
Carlene.
Carlene, this is Carlene. Carlene, this is everybody.
My last name is too long. It goes on forever.
Carlene, are you already an investor? Real estate. Great.
Why not be?
Well, and that's why we're here, isn't it? I love it. Who else is here for the first time? Calder also is speaking with us on the Swope team and hopefully going to be joining the Swope Investment Properties brokerage. So that's exciting news for Calder. Maybe for me, I look forward to seeing if you need some extra work. Great. Who else is here? First timers. Intel.
And no, I was not part of the people burning down the courthouse. Here, I've been doing some dirt investments and doing some wonderful stuff so far. So looking to meet a few people and go from there.
Welcome, Darren. Good to meet you. We've been emailing, so it's good to finally catch you. This is a new member form. You're welcome to fill it out if you'd like. And thanks for coming. Jerry, this is your first time here too?
First time face to face. And first time on Zoom.
That's right. Welcome to the club. Say hello. Tell us who you are. Well, we're glad you're here. I think Jerry's an avid investor already. We're called avid investors, but we welcome newbies. We welcome seasoned and experienced investors. We welcome you to bring your have, wants, and coming soon, and your real estate questions. So we can all help each other out, because that's part of the goal here. Shoot. Well, the other goal is to be able to change a slide, but oh, that's a great idea, Shane. And I don't know if I'll hear, but will you help make sure I answer? Anyone on Zoom here for the first time? We can't tell. Welcome everyone from Zoom. Let's see, we have Bobby. Hi, Bobby. We have Will Walker here. We have Aaron's iPhone, Brian, and Steve. Hi, Steve.
Hi, Stacy.
Others succeed. And I have always believed that success is best when shared. And so today we're going to put you in front of some people who can help you succeed and help answer questions. And I hope you have a great meeting. Now, to start the meetings off, we like to talk about haves, wants, coming soons. And anytime something makes the board, we bring it back up so you can follow it through. And so last week we talked about a North End condo, and you heard it here first, and then we did indeed list it on the market. It was listed for $369.9, and it ended up closing since that last meeting for $425. Yeah, right across the street from the Boise Co-op, and wasn't only because we did such a beautiful listing for them, the market had a lot to do with it as well. So we had multiple offers. Last month, we also had a short-term rental property manager here, and he had done a short-term rental analysis on the property. And that is what the buyer is going to use it for. They're going to do a short-term rental in that condo across from the co-op. And so that short-term rental income supported a higher purchase price. That's how they were able to make that offer. And there's certain properties we talked about last month that are better for short-term, and others not so much. This one here, same story. Buyer plans to continue to short-term some of the units. This was an owner-occupied triplex. We listed it at, what the heck did we list it at? Whatever we listed it at, it sold for a lot more at $895. I think it was $840, $839.9, and it sold for $895, multiple offers. We also introduced a property on Warm Springs Mesa, and I did not realize until starting to work on this property how much people love that neighborhood. In meeting all of the neighbors there, the folks who live there, they will buy a bigger house there, they will remodel there, but they don't seem to move out of the Mesa. This one hit the market when there was actually a bit of a rush of properties coming on the market in early June. There was a little blip in the system, and it did not fly off the shelf. So all three of those were promoted or showed to you first at the last meeting. And this one is indeed still available. So there has been a price adjustment on it. If anyone's looking for a swimming pool and an amazing house, hit me up for more info on that one. 5-bedroom, 4.5 bath, 2-car garage, huge lot, huge swimming pool in the back, private view. The landscape is over here. It kind of shelters the pool. This is the master overlooking the pool. There's a balcony over the master that you can see Table Rock from. It's amazing. Not necessarily something I see as a rental, but hey, rental owners just love real estate too. So This one was actually a rental. This is the Ada County Assessor. It's 1700 South River Chase, and it would have potentially been an estate at some point, but instead the son rented it to some folks, and they recently moved out, and so it's being prepared for market now. It has a little value add potential, which I know us investors like. It's in a great neighborhood in Eagle, but it's 4 bedrooms, 3 bath, 4-car garage. The 3rd and 4th garage bay are tandem, and it has no back neighbors, and it's on a little private stream. So in total, it's maybe 1/3 of an acre of land that you get. Although some of that's a second lot actually behind this little stream. So it's nice to have no back neighbors. And this will have opportunity to create your own kitchen. It's built in 2000, so the kitchen still has a lot of 2000 character traits. And the master bath also could serve fine just as it is, but someone might also want to play with those 2 things, and it'll have all new paint, new flooring, and be great and welcoming. So that's coming in about 2 weeks, and it will be priced for less than $1 million, despite the fact that it has almost 3,000 square feet and 1/3 of an acre lot, no back neighbors, and a main level master suite in Eagle. This 4-plex will come soon for about $850,000, and it's quite possible the market will do some bidding on this. We've seen markets bidding 4-plexes up in both Ada and Canyon County, and there's just not a ton of inventory, as you'll see. But this one has 2-bedroom, 2-bath units, which is nice, and they're about 928 square feet. And as you'll notice, there is indeed a difference between the market and the actual current rents. And so that's something that we're still seeing. When we're listing and running the numbers, we're running our cap rates on current rents. But especially last year, people were not as aggressive. How many people here who could have had a rent increase last year or have tenants did not increase their rent as much as they might otherwise due to COVID? I for sure. Okay. So I think I saw about 6 hands go up. Now, does anyone have rentals and did do the standard increase regardless? Okay. So about 6 to 1, if I counted hands correctly. So, so yeah, we're doing there's a little bit of catch up for most of us, not Chad though, but a lot of us are doing a little bit of catch up on those rents. And here's what you're seeing with the trends. Inventory is low, and we had a little blip last month, but it dropped back down with Ada County duplexes dropping the most at -12 units since last month inventory. Pendings cut in half, but of course you can't go pending if you don't have inventory to sell, and same with sales. And so sales dropped only by 2 from 26 to 24 in Ada and Canyon duplex 4-plex sales. And absorption, we're seeing a little bit over 1 month in all the categories, and Ada County duplexes are less than 1 month absorption. And that's how long it would take for the market to absorb all the current inventory in that category. And a balanced market would be considered about 3 to 6 months. So yes, it's still definitely a seller's market. There have been micro ebbs and flows, and we've seen that in the $1 million+ price point. We've seen little ebbs and flows in June and early July. Everyone kind of got through Memorial Day and went on vacation in Idaho, and some of the price points saw that, and some didn't. But overall, the macro trend right now is still a seller's market. And so that puts cap rates at June just under 4%. Now that's on current rents. So when we run it on market rents, and most of us here, so 6 to 1 kept their rents a little lower in these last renewals. And so the market rent cap rate would actually be a little bit higher than that, probably closer to 4.5% when you're running your pro formas on market rents. But actuals, yeah, we're barely at 4, a little below. And the average price last month was $835 for 4-plexes, and that'll be, it's going to be affected by the age of the 4-plexes listed. There's not a ton of them selling, and yeah. And last month we talked about one that was listed for $1 million, a 70s 4-plex that was listed for $1 million. That one's temporarily off market. So look at these days on market, right? Wow, less than 5 days on market. And it would really actually be lower. But that's about how long you leave it on market to collect all your offers. So, you know, that's pretty much, it's flying off the shelf with multiple offers right away on a lot of these. So the gross rent multiplier, that's another one of those metrics, the rent to purchase price ratio, where we talk about it still adjusting from the relaxed increases in rents the past year. So that number, the lower, the better for investors. And it did do the tiniest little dip last month where some of the rent increases started kicking back in. So last month, that number was a little less favorable for investors than it is this month. And Tony did a great blog article on that. BoiseInvestmentProperties.net is where we're putting some of the blog articles, and there's one that talks about this very thing. So this is what's currently available for Ada County and Canyon County fourplexes. And let's see if there's anything special to mention on this. And this is everything that was active today in Ada and Canyon County with 4 units. Yeah. Yeah, that's all. Great question. Yeah, so the new build fourplexes, they may still be in the building process. If they have hit the market, they have come on the market and they're under contract. So they're not going to be active, they'll be pending. So we've seen a lot of those come on, and you'll see if, you know, similar street names, repeat street names where they're going through and selling new ones. But right now there's no active new builds at this moment. Mm-hmm. And I think that one, yeah, that one is indeed new to market. And when you look up that listing, it's interesting. It says it has 2,600 days on market. And in a different kind of market, that would really hurt an agent. But in this case, it doesn't. But they just probably data entered something. It was a typo. But once you get that number, it's hard to get rid of it. So if you see super high days on market and you're thinking that can't be the one that we talked about being new, it is. Yeah. So that one of the deals that we recently listed and sold, I worked with Mike Slope on it. It's clients who've done 98 deals with him. And so I quoted them on just sort of the water cooler conversation that we had with Mike, where they were saying, wow, we have to keep pinching ourselves to even believe this market. And, you know, it would have been nice to live through a couple of these in our lifetime as sellers. And Mike says, gosh, I'm not sure we'll ever see a market like this again as sellers. So it's still a good time to sell. Here's what's currently active in Ada and Canyon 5+. Now you've often, if you've been here before, heard me talk about how Idaho and how in this area we have more fourplexes than 5+. And this number is bigger right now than our fourplexes because all of these 15, they're all the same. And so an investor is selling off a 15-unit portfolio that's in various places and spots and addresses. So they've listed it under multiple addresses. And I think some of them are single family, some of them are trailers. This Franklin one, you see it had a price drop, but it was also a pretty aggressive price. And that was a price that was justified using short-term rentals. So this one has 8 short-term rental units in it. And so that was just more than the market was ready to tolerate, even with already higher short-term rental rents in place. And if we're talking about that, remember last month we did that study, and you don't always gain a whole lot extra when you factor in the increased expenses. So if you're ever thinking of doing that, we recorded last month's Zoom, and that one is indeed on YouTube already. And so it could be worth a reference if it's something you're seriously considering. Now, this one here is interesting. This 16 units for $4 million. Mike and Shane in our office are listing that, and that price has some room in it because there's room in the land to build 12 more 3-bedroom, 2-bath, 2-car garage units. And there's plans in place for it and some sort of city approval in place for that. Now it blows up my brain when I try to quantify that and put it into a pro forma for everyone. But the gist of it is you're getting 16 units that are townhouse style, already renting, and then you have this opportunity as well. And so it's a bit of a hybrid scenario where you can be a developer and reap cash flow from that same project. Well, the single family home, you probably had an idea of what it's doing, that market. They report on it in the news a lot locally here. And I think in California, New York, and every single state in between as well has heard how our single family home market's doing. And yeah, we're up to $500,000 for the median price of homes in Ada. And in Canyon County, that is a little bit lower. It's 100,000 lower, 525 to 424. But you'll notice the trends. Basically, everything's up in terms of sales price, 40% and 48% increases in Ada and Canyon. But then everything that's down is number of homes sold due to inventory. In Ada, we've had a decrease of 25%. This increase in Canyon County's inventory probably is the reason I've ended up selling a few properties, brand new build properties to investors in Canyon County, which wasn't something I'd been doing before now. And that's probably why. There was probably a little bit more opportunity there. And days on market is down by almost 69 days year over year in Ada and 62 in Canyon. So these properties are just moving a lot more quickly. The whole market's moving a lot more quickly. So I feel really fortunate to be among all of you because we're here probably because we already own real estate. And so good job for that. And save up if you have kids, you're probably going to need to help them because I feel really badly for the folks who don't own already in this market. I don't know about you guys, but I kind of got started, you know, just one property. My first house was a duplex and mom helped me with my down payment and that number looked like $20,000. And now the first time home buyers who've saved up their $20,000 or $30,000 even, they're trying to buy a home, it's getting bid up. They're competing with cash investor buyers who can release appraisals and bid it up 50,000, and they have the extra cash in their pocket to throw down if it doesn't appraise. And that cash buyer who saved up $30,000, that's a 5% down payment for them. That's all they're putting down. And they can't waive an appraisal and take on 50,000 worth of risk. So good job to be you. And thanks to my mom for helping me get started, and anyone we might have to, I don't know. We'll do what we can, but we do know that nothing lasts forever. So maybe change will help these folks or parents, and we'll see maybe more multi-generational living, who knows. But as the housing market heats up and this property market is so hard to get into, my tenants were going to buy a house, and instead they've re-signed their lease for 2 years. And so we've got a lot of influx in population. And then we also have folks moving into the rental market, which is what's going to put our vacancy at nothing. We've got no vacancy here. And so the rental market's also very competitive these days. And some of these rents we went through, I couldn't get the latest NARPM data. It's probably going to be out tomorrow just to spite me, but these rents are low. So this is Q1 data. We'll see how it compares by next month. I didn't want to not include it, but just let that make all the bars come out a little further. Yeah, because even in Q1, it felt like these numbers were based on survey respondents who were kind of had a winter mentality, or those rents those increases we didn't do. All these numbers seem a little bit low, so I'm not going to read them off. But if you want to reference them, and if you are looking at what is your property worth now, I recommend, we can talk about it individually. We can get you in touch with the property manager, but it'll be above this. That's what we do know. Any questions on the market, the rental market, and this real estate update? Okay. Well, so we have 2 feature speakers today. Very excited to present. And we're gonna, part of the reason it's so great that we have both Matt Craner, a commercial lender here, and Tyler Porter of OneTrust, who kills it on residential loans, is because one of the other phenomenons of this market that we're experiencing right now is just the overall low cost of money. Interest is crazy. You guys are hooking us up with amazing interest rates right now. And so you've got property, you've got equity. Do you want to put your cash into a property? Do you want to leverage it? And it's always nice to keep up on what interest rates are doing, especially in the residential sector. There's been some crazy changes with what's going on with residential lending that you should hear about. And Tyler can brief us on that. But you know, I'll leave this slide up here for now, in terms of why do we finance deals versus why do we pay cash? Because when we have interest rates that are as low as you're seeing right now, it's good to remember these things. And I'll tell you in a minute. I think Matt, what I'd like to do is start with you. Come on up, Matt Craner of Westmark Credit Union. Matt has, we have a lot of national folks, as you know, coming into, and the mat's pretty comfy if you have a lot of folks coming in from everywhere. And sometimes they try to bring national lenders with them. And Matt, you kick those, you kill it.
We don't use many deals, that's for sure.
Yeah. Yeah. Or I mean, well, no, I mean, but your rates, you also, you can outdo the rates. So this is, to advance the slide, this is the next slide that's up. Maybe I have a duplicate there. I'm not sure. Oh yeah.
Unmute myself, sorry about that.
Oh, thank you, Shane.
Okay. All right. Can you hear me now? Okay. So, yep. My name is Matt Craner with Westmark Commercial or Credit Union. I do the commercial lending for them. We're a credit union based out of Idaho Falls, and I'm the only lender that we have over here in the Treasure Valley that does commercial lending. I primarily focus on commercial investment real estate. But for tonight's little discussion, I'll kind of excuse all of our commercial properties and we'll focus on how we view multifamily properties. And in my world, we basically handle everything 5 units and above, because 1 to 4 family qualifies for special exceptions. I'm sure Tyler will talk about it a little bit. So that being said, real quickly before we get in, I worked for Wells Fargo for 10 years and worked for them in North Carolina, and then worked for another investment bank in Seattle, Washington for a couple of years before I came back. So I've had a chance to see the markets a little bit, and Boise is definitely a great market to be working in. And what I'm going to cover tonight is just how our credit union, a lot of other shops, look at qualifying borrowers for investment real estate. It was focused around these 3 primary pillars of repayment. Our primary source of repayment, we're always going to look and do an analysis on the property. And I think you guys have done that before, where we look at net operating income. So your gross rent plus expenses, your net operating income, and compare that to the annual payments associated with the loan. So you have your loan terms, your interest rate, amortization, and the loan amount. In the commercial world, we rarely do a loan term above 15 years. In fact, that's my regulatory maximum is 15 years, but we will set our amortization rates for longer than the term of our loan. So that'll mean that you have a balloon payment at the end of the term, which you then have to refinance, or you can sell, or whatever you want to do. So that's one distinction to kind of draw between the commercial side and the residential side of lending. So we'll talk a little bit about that. Then the secondary source of repayment that we focus on is our sponsors or our guarantors. And so that's why we ask you for personal financial statements and tax returns, things like that. And what we're trying to do there is understand what happens if you experience vacancy for a short period of time or a long period of time. And do you, as the sponsor, have other outside sources of income or personal assets that you can use to make your loan payment while you have a tenant, occupy the building? It's not a very hard thing to do in Treasure Valley at the moment, because, like you said, rental rates and occupancy rates and everything being what they are makes that not so necessary at the moment. And then the tertiary, the third source of repayment that we have, is where we actually look at the collateral itself. And that's where we do things like loan to values and that sort of thing. So I'll just take you through this and I'll talk about each one of them. And if you have any questions, jump in and let me know at any time. So the primary source of repayment, this is an actual live deal that I did this year. And this is the actual charts that we used. And here is just the P&L, the pro formas that I'm sure all of you have probably seen before, where we take the revenue. We do stress testing, so that's why we apply vacancy factors. And And we always do that for downside risk reasons and things like that. And then all of your expenses. And then we estimate and calculate what your loan payments will be based on a factor. So this particular loan was a $1.8 million loan at a 4% interest rate over a 30-year term. So here I'll kind of talk a little bit about the way that we price and structure our multifamily. At Westmark Credit Union, we put all of our commercial real estate into two buckets: multifamily income producing property from residential tenants, and then commercial properties. So I'm only going to be speaking to the multifamily stuff. So our commercial stuff has different rates and structures and all that. Yes.
Would you mind covering the stress testing?
Yeah. Okay, sure. So as you can see here, we have three columns: the historic P&Ls, and we usually get those from historic tax returns or a pro forma if it's a new property. And we always order an appraisal. So an appraiser will tell us what market rents are and that sort of thing. And then I do my own stress testing. And what we're basically stressing is additional vacancy factors. And that's just, primarily we're stressing for what's called frictional vacancy. So just the amount of time it takes to get one tenant out to another one in. It's usually a month. So that's what we're always putting those in. And we might put additional stress factors in and above the normal payments that you would have to pay, like utilities and things like that. We'll sometimes put in a property management fee. And it's very common for banks because we don't actively manage the properties ourselves if we ever have to take them back through a bankruptcy sort of process. So we'll always put in a management fee and then a replacement reserve fee. Appraisers do this a lot as well. We put a higher reserve replacement for an older building that might need to have some sort of work done. Even if you haven't replaced the HVAC this year and maybe it's okay, we'll still put in some sort of factor there because things go wrong and you have to make CapEx expenditures, things like that. We might also put in other vacancy factors depending on what we're looking at. Yeah.
What number do you use for capital reserves and replacements
So
on older?
It kind of depends. A general rule of thumb is we will do $250 per unit per year. And if it needs more repair and things like that, we'll increase those amounts. I have some discretion about how much I use. So it's something that we work through and we do a little bit differently on every deal. Hope that helps. In this particular example here, there's a common expense ratio that a lot of appraisers will use in the Treasure Valley, especially for new properties where you haven't had these historical expenses. And I think in this particular example, I used 38%, usually between 30 and 40% as a general rule of thumb for your expense ratios with multifamily properties. And so that's what we're all trying to do here. And you'll see we have something called a DSCR, and that stands for a debt service coverage ratio. And what we're looking for in that is your net operating income the property generates. And so there's three different numbers here based on the three sets of stressing that we do compared to your annual debt service, your loan payments that you have. And again, we're $1.8 million loan at 4% over 30 years. And so when you divide your net operating income to your annual debt service, that's your debt service coverage ratio. And so you see here it's 1.4 times 177 and 163. At Westmark Credit Union and a lot of other banks, the minimum debt service coverage hurdle that most banks look for is a 1.25 times debt service coverage, meaning for every $1.25 that you earn from the property, $1 of it can be applied towards the debt service. And that 25 cents difference provides you as a cushion, a little bit of a return as an investor, hiccups for those replacement reserves, other CapEx things. So that's where a lot of banks are comfortable with. That's where we are comfortable with a 1.25 debt service coverage. And because this is our primary source of repayment, this is the first thing that we look at in that whole step. Right now in the Valley for multifamily, my department will structure investment loans for multifamily properties based on a 15-year term. We can go as far out as a 30-year loan amortization. Some other banks do 25 years and things like that, but Westmark will do 30. And our interest rates for multifamily projects are in the low 4%, depending on the overall characteristics, which I'll talk about at the end here, of the borrower. 4 to 5% is kind of where we're at for these types of projects. So that's the debt service coverage, and that's how we look at the primary source of repayment for our loans. The secondary source of repayment is where we do the financial analysis of the sponsors or the guarantors of the project. So we, generally speaking, require personal guarantees for all of our loans. There are times where we offer what's called non-recourse, meaning that you as the individual owner of the property don't have to sign the guarantee. So the bank then has to look at the project a little bit differently because we don't have an individual there with outside sources of income or cash that can step in and cover those cash flow shortfalls. we only have our primary source of repayment, the income generated from the building, or the repossession and liquidation of the building itself. They usually get around that by lowering the money that they'll lend, the advance rate or the loan to value. But we typically require a general or a guarantor on all of our projects. So we ask for 3 years of tax returns anytime we're doing a deal, and a personal financial statement. And the 3 years of tax returns help us understand your income, your outside sources of income away from the project that you might have available to you to make those payments should you have some vacancy at your project. And then a personal financial statement where you disclose your assets and your liabilities. So we know what kind of debt payments you have and things like that, and what other kinds of assets and liquidities you might have to help you, through your occupancy issues there. And my team, when we do what's called a loan proposal, I'll take a project. Somebody will send me a purchase and sell agreement or a pro forma on a property they're looking to buy, along with their tax returns and a personal financial statement. And we don't want to necessarily pull people's credits and damage their FICO scores and things like that. So we will accept at face value what you disclose in your personal financial statement to create this global debt service coverage ratio. So we talked about debt service coverage when you look at the income the property generates versus the loan payment that it has. Well, now we add in your other income versus your other debts, your mortgage and your car payments and things like that. And again, we look for a global debt service coverage ratio of at least 1.25 as well. So that's kind of a threshold that we have at Westmark Credit Union. We do look at credit reports once we make an offer and you accept our loan proposal and we agree to terms and all of that sort of stuff. In my world, the FICO scores themselves, the numeric score, isn't particularly important. It's important that we look at your payment history and that you have a good history of making payments. We generally don't lend on what we call subprime lenders, where you have a FICO score of 680 or below, but we can always make exceptions to that. I have a lot more latitude in my world than residential lenders have that sell their loans to Fannie Mae or Freddie Mac or other government institutions. We keep all of our loans on our books, so I have more discretion of how I do my underwriting. And the reason for that is if something goes sideways, I'm also stuck working them out and trying to negotiate and go through all of that piece of it. So something I thought I would bring up. And then our tertiary source of repayment is where we look at the collateral itself. And so this is where we order full scope appraisals. So in my department, we delineate full scope appraisals versus kind of a desktop review appraisal based on the loan amount. So anything over $1 million, we open up bids for appraisals to MAIs around the valley, and they'll write us a 100-page report, talks about everything, the property, the market, and all that sort of stuff. Those usually have a cost between $2,000 and $5,000, depending on the type of property you're looking at and the complexity and things like that. So over $1 million, I go with a full scope appraisal, as we call it. And in a full scope appraisal, they'll generally give us a sales comparison approach. So that's when they look at all the properties, how much they sold for and all that sort of stuff, but also the income approach. And that's where those cap rates that Stacy was talking about earlier come into play. And again, it's this exact same formula where you have your NOI and you multiply it by a cap rate, and the lower the cap rate, the more expensive the property, and so on and so forth. So then they reconcile those two approaches. Sometimes with construction, we also get a cost approach, but those aren't generally as important for what I do. With commercial real estate valuations, I can order those on any loan that I do that's under $1 million. And folks like those because they're much cheaper. So I have a standard flat cost of $845 as opposed to the $2,000 to $5,000 that you might expect to pay for a full scope appraisal. And they're quicker turnaround times as well. I have a service level agreement with our appraisal company to provide it to me in 10 business days. And that's another one of our competitive advantages, is how quickly we can turn around deals. Because if it's under $1 million and I can do all of my underwriting concurrently with the appraisal order, by the time I get the appraisal back 10 business days later, I can usually close a deal within 3 business days. So we routinely close commercial transactions within a month. Some other lenders, 45 days to 60 days, things like that. So as Stacy mentioned, we're kind of competitive in that route. Another thing that we get that I don't believe 1 to 4 family properties generally require, but I'll let Tyler speak to this more, are environmental reports. Generally in Boise, there's not a whole lot of issue with contaminated soil and asbestos and things like that, because a lot of the properties around here are newer relative, to America. But when I worked in Seattle and around Tacoma and stuff like that, a lot of people heated their house with kerosene, and they'd have tanks underneath their houses and stuff like that. So we do order an environmental report on all of our properties. And again, we kind of delineate based on the loan amount. If it's under $1 million, I do quick database pulls that, are fast and I get them immediately. But if they're bigger transactions over $1 million, to get us to substantial costs as well. Generally happens more in the Treasure Valley with industrial type of properties, warehouses, retail stuff. Garden City had some of it, historically, and those can run, $3,000 to $5,000 as well, and take a significant amount of time. So something to keep in mind as you're looking through there. But I thought that'd be a good overview of how we generally view commercial real estate lending, our three sources of repayment, what we look at in each step, and what you as investors should probably be looking at as well. A commercial lender, just so you kind of are going to be looking for anyway. So that I'll open up to any questions you might have, or we can talk about it after that. Yep, no problem. Oh, interest rates. Yeah. So Stacy had asked me to give just some general information about how we are currently structuring our loans. Interest rates, like I said, between 4, 4.5, 4.75, depending on the character makeup. So we look at all three sources of repayment and we take all of that into consideration. And that is called risk-based pricing. So the more perceived risk, the higher the interest rate return on our money that we look for. But for the most part, our interest rates are in the low 4s right now. Our down payment minimum is 20%. So we require a 20% down payments, or the way we talk about it on our shop is our advance rate. So I can advance 80% of the purchase price or the value of the property. And then our loan terms, like I said, 15 years, 35 years. And one other thing I think I should mention regarding the interest rates is we base all of our interest rates off of an index called the 5-year Treasury constant maturities. It's available through the Federal Reserve. It's posted every single day. Those fluctuate some. Right now, the 5-year Treasury, the 5-year maturing Treasuries are 0.81 to 86. And so then we build a spread on top of that. And so our interest rates work this way, where we fix them for 5-year increments. So in a 15-year loan, you'd have 3 5-year increments. Our interest rates are fixed for 5 years, and at the end of the 5th year, it resets to whatever your predetermined spread is over that current Treasury rate. And then it's fixed for another 5 years, and then another reset, then fixed to maturity. So that's something else to consider. We do offer fixed pricing, so we will do fixed interest loans for the full 15 years. But generally speaking, because we are now assuming all the interest rate risk, those interest rates would be a little bit higher, maybe closer to 4.75 to 5% or something like that right now. But we do have a distinction between our variable, adjustable, and our fixed interest rates. One other thing that I didn't mention, because we don't do it at Westmark Credit Union, but some of my peers around here in the Valley and elsewhere do, is they put on what's called a prepayment penalty or an early payoff fee. So if you purchase a property and you have a loan and you sell it or want to refinance it within the first 3 years, 5 years, or something like that, you may have to pay a fee. So I have had people approach me wanting to refinance their loans because interest rates have dropped over the last year or two. But then they come to find out when they go get a payoff from their lender that they have a substantial prepayment fee. So we don't put any prepayments on our loans. And that's another one of Westmark's competitive advantages that I like to make people aware of. And if you're shopping with other banks, probably something you'd want to be aware of as well. Some people will purchase property, and because we're in an appreciating housing market or appreciating real estate market, you can do cash out refinances where you pull some money out of the property that you can then leverage to buy more. But a prepayment penalty may stop you or prevent you from doing that. So that's the only thing I wanted to mention. So
Thank you.
now I think I'll hand this back.
Thank you.
Hey,
We'll
thank you.
ask you to come up here in a little bit for questions as well.
Sounds good.
Tyler Porter, come on up. OneTrust. Guys, in a market that is as aggressive as this one, you need to have a really good lender if you're out there buying and making offers. It can literally be the difference between your offer being accepted and not. And so that's another reason it's so important to bring up Matt and Tyler today. And Matt, like he said, on the fast closes, and Tyler just recently helped me with a condo sale. If you're ever selling or buying a condo, sometimes that can be a little bit different as well. And yeah, so thank you for that. You killed it.
Yeah. I don't know what you have for slides now, but just a little bit about me.
Oh, right.
How about now? Can you hear me now?
Yep.
residential rates on investment property typically have always been about 3/8 to 5/8 higher than a owner occupied property. But last year, in April, Fannie and Freddie changed some rules, and the rates have fluctuated drastically between lenders. So truly now, when you do find a property that you need financing on, you really need to shop that more now than you probably ever have, because what Fannie did is they are limiting the amount of investment properties and second home loans that go into the pool to Fannie and Freddie to 7%. And so lenders, to combat that, have had to increase their rates because they currently have more than 7% in their portfolio. So you'll see a huge fluctuation in investment property rates, truly from 3.375 to 4.5%. And it can be the exact same property, same credit scores and everything. So you really need to shop it for a while between several lenders, because even my rates today might be completely different than they were yesterday by 1%. And it's just because of how many we see in our portfolio. Okay, our numbers are getting too high. We have to cut down on investment properties. And so they jack the rate up essentially so that we don't do any loans that are on investment properties. So you need to shop around a lot right now for that. Hopefully that'll change. Mark Calabria was the director of FHFA, and he was just ousted by Biden. And since they got rid of him about a week and a half ago. And since that change, there's still no new director. But I don't know if you heard about refinance fees being added to all loans, all residential loans last year. When did that happen? September of last year. There was a 0.5 fee added to every single refinance. So anytime you're going to refi, whether it's investment property, primary residence, there was a fee added, and it essentially it increased your rate by 1/8%. So it didn't cost you any more money out of pocket, but the interest rate went up because of that. And that was the first thing that went away when Calabria was thrown out. That refinance fee went away. So all your pricing for refinances should be about 1/8 better this week than they were last week. What do I have on here? Current rates for a fourplex, $850,000 purchase with 25% down, and you on 2 to 4 units, you're going to have to put 25% down. If you do a single family property, you can do as little as 20% down, but it's a pretty big rate hit between 20% down and 25%. So it usually doesn't make sense. Typically, you just put 25% down on a single family as well. So fourplex 850 purchase price of 25% down is 3.375, but that's a 2-point cost today. The reason that's such a big cost is partly because of these changes that happened to FHFA last year, and there's a 0.75% hit to basically every investment property and every second home. And our hope is once we get a new director in, that fee will go away as well, and the pricing for investment property will get better. But
Where does that fee go to, the government or?
it goes to Fannie or Freddie. Yeah. Single family non-owner, 25% down is the same. Ironically, when I priced this out this morning, it was actually more expensive to do a single family than it was fourplex. And I think the reason is, I don't know this for a fact, but I think the reason is because the loan amount was lower. And with a fourplex, $850,000 purchase, the loan amount's over 600,000. And that could be different a week from now. It might be better on a single family versus a fourplex. It just depends on what pool of money people are trying to get that week, really. To compare it to a single family owner occupied today, it's 2.875 at one point. Duplex non-owner occupied rate 3.375 is also at the 2 points. Duplex owner occupied 20% down, 2.875 at 3/4 of a cost.
You mentioned something about doing a down payment 25% versus a down payment of 20%, and there was some advantage or disadvantage.
Yeah, so the rate on 20% down is, my guess is it's going to be about a 0.5 point interest rate higher. Yeah, so a worse rate for 20% down versus 25. Yeah. What else did I want to tell you? Oh, that 0.5 point refinance fee actually doesn't go away until August 1st, but its pricing will get better when that happens. Yeah.
I mean, these are great rates.
Yeah, the rates are amazing, truly, but it's costing more right now. Like basically this same scenario without the 0.75 fee that the FHFA is charging, it would be the exact same rate, but the cost would be 1.5. So pretty significant for investors. So I think you're going to pay a little more, 2 to 2.25, as opposed to 1, until they get rid of that fee. But my belief is that will go away in the next year, but it's going to take some time. Any questions?
Thank you so much, Tyler. And then also, okay. So money is free right now, but we've got to watch our points. And there's a lot of cash in the marketplace to compete with. So you may need to use cash to buy and then do cash out refis later. So there's a lot of reasons to think lending right now. One might be refinancing and losing these fees. One might be cash out refi to compete with cash. Diana, you also are seeing a lot going on with people using self-directed IRAs, and you had prepared a couple numbers as well.
Yeah, some of the most recent.
Would you, I'm so sorry, can I talk you into coming right in front of this microphone?
You're the microphone.
It's just this phone, right? I was using that, I don't have my earbuds in,
Oh, I see.
so that way,
Oh, my phone's still up there, so that's probably.
okay.
So one of the most recent non-recourse loans one of my clients did was actually through First Bank, which is out of Colorado. They were actually purchasing in Colorado. They got a 15-year fixed for 3.75, but they also put down 40% of the property. Now, where they were purchasing, that wasn't as big a deal as that would be here. 40% would be enormous here. They were buying in a little suburb, and they actually had a pretty decent rate. But that's most of what we're seeing in the non-recourse, because of course, inside of an IRA, that is the only kind of loan you can get. Now, on the flip side of that, we have people with IRAs who are lending out of their IRAs. For the most part, they're either lending to funds or they're lending to people who are investors who are doing fix and flips or buy and holds, where they just need, they've purchased the property and they just need extra funding to get it up to speed. So I have a lot of my lenders that are doing gap funding. Now, I'd love to be able to give you a rate for that, but truthfully, that is all over the map right now. It really depends on if they have a previous relationship, if they've done previous loans in the past. I'm seeing much higher rates when they're lending to someone for the first time. I see lower rates if they are in first position. Right now, most of the promissory notes that I'm seeing going out are not long-term, they're short-term. And I think it's just people with the market uncertainty. They don't know where things are going, so they're being kind of cautious. But I've seen loans going everywhere from 4%, but those two do stuff together all the time. They've also been friends since elementary school, and they're older than me, so I'm old. And then I've also seen them as high as strictly points, where they're lending for like 1 year. I saw one go out for 10,000. It was just some gap funding, and they actually did 5 points on it. And they have the whole year to pay it back. They can do interest only, or it's just depends on who you know, how well you've gotten to know the lender and what they're doing with their IRA. So lots of opportunity, and boy, I kind of thought this market would slow down deals and stuff, but I think it's actually increased because we are busier than ever. So people are finding the properties and they're finding the non-recourse loans, and I'm very happy to hear that you guys do occasionally do non-recourse loans. I might have to get your information to pass it on to some of my folks who want to do local. But that's about it. Any questions?
I have a question. Could you explain the significance of like the 5 points, put some dollar signs to it, or some interest or percentage of?
Sometimes
costs?
when people are doing short-term loans, if they're doing a short-term loan at 5%, that's going to be so tiny because it's going to be paid off so quickly. If they do strictly points, they're going to say, hey, I'm going to lend you $10,000, and in 1 year, you're going to pay me back 15. That's easier for them to do. They don't have to do an amortization schedule because it's such a short amount of time that money's going to be out. And a lot of times they're paying for the convenience and the very quick close. That's private money. I'm sure a lot of you guys who've been investing for a while have seen private money. It can be hard money lenders, or a little softer than hard, depending on who you know and when you know. But it's much easier to do a loan that's short term when you basically say, I'm going to lend you this much and you're going to pay me this much back by this date.
So how much is 1 point on $100,000?
Thousand. Yes.
Perfect. Thank you.
Yes, thank you. Sorry. But you wanted specific.
Well, no, it was better.
He's
Your
an engineer.
explanation was
He
much
likes
better.
specifics.
Oh, there you go. Yes. I worked at HP for a long time. I know engineers. So any other questions? There you go.
Thanks, Diana. I appreciate that. So Mountain West IRA, any other questions on lending, financing, overall commentary on what it's doing, anything like that?
Do you happen to know, I lost my question.
Oh, my computer died. That's what happened.
Oh,
Is the meeting still going on Zoom through here?
Yeah.
Yeah, okay.
do you happen to know if anybody's doing HELOCs?
Yeah.
You do.
Are you doing HELOCs, Tyler Porter of OneTrust?
No, I would go to a local bank.
Okay. You're not doing HELOCs, are you?
I don't personally do it, but we have mortgage officers that do our HELOCs for us.
At Westmark Credit
No,
Union?
Westmark, yeah.
So, okay, so Westmark Credit Union, yes. Idaho Central Credit Union, yes. They were booked out 100 days a while ago, but I heard they caught back up. And they have really good rates as well. And
Zions is who I usually send people to.
and Zion's.
Oh,
That's good.
well, it wasn't for me, but
Yeah, okay.
Do Earl,
Sorry?
you
do a revolving line of credit as well.
Mhm. Yeah, you could do a revolving line of credit, yeah. Yeah.
I have a question on the, you mentioned you don't do loans unless it's like 5 units or more. Is 5 units, or sorry, could you do a loan on 5 houses? Or
I
just a
could.
5 unit? You know what I'm saying?
Yep, I could, and that's just a general rule of thumb. I do have people that I work with on multiple deals, and I finance single family residence for them. The same terms. I just don't get a lot of that business because we don't have fully amortizing loans. I can't offer you a 30-year fully amortizing loan. And as you saw from Tyler's slides, my interest rates are about 100 basis points higher than his are on an annual loan. But sometimes it makes sense, and sometimes our folks do want to do that. So I have lent on 4plexes, I have lent on 2plexes and single family homes. Just that's not the bulk of my business.
Okay. Yeah, I was gonna say, we also applied for, we were going to get some financing for some houses. And we had a prepayment penalty that required us to pay off the property on an exact date. If we didn't pay it off on that date, then we got charged a big penalty. Yeah.
Typically, the way that I see banks structure their prepayment penalties are a 5, 4, 3, 2, 1 scale or a 3, 2, 1 scale. Meaning that if you pay it off in the first year, you have to pay a 5% fee based on your loan amount. Then in your second year, it's a 4%, 3%, 2%, 1, and then it expires, or it starts at 3%. So they are common.
Yeah, I think ours was 5 years, and if we didn't pay it off on this like January 12th or something, that we got charged. I don't know what the fee was, but it was pretty high. So
yeah, look at your closing statements because banks put all kinds of stuff into loans. That's for sure.
Yeah.
Okay, so the market's really crazy and competitive. We've talked about that today. We've talked about some great financing options if you are trying to take advantage of the market. Anytime you can get a leg up, whether it's in a commercial loan, the timing, the turnaround time, a good rate to help make your numbers make sense. Tyler Porter said something really interesting in this session where he said, you really got to shop your residential loans right now. A lot of times, I'm of the mindset where you establish your people, you establish your team, and you stick with it. You don't super nickel and dime. I mean, we're frugal investors, but still, you go with what you know, and you go with who's going to get the job done for you. And so, to hear Tyler saying, yeah, right now you got to shop it, it's really interesting because there's just been these revolutionary changes in lending right now where it's not a small difference in an interest rate that's $20 or $50 a month. It's a percentage point of the loan, a percent of the loan. If they're not wanting to make loans to investors at the moment because of this Fannie Freddie change that Tyler explained. And so I've been so grateful to be able to include Tyler Porter on my power team now, and I've needed it because, like you said, one day you've got the absolute best rates in town, and then one day you may not. And so keep your power team, know who you're working with, but also, when they're really watching out for you, they're going to be able to tell you, hey, I don't have the best rates today. And that's a true character trait of somebody you really want on your team. And so with the refinancing of fee being removed and rates being what they are, if you've been thinking about a refi, it's a good time to finish those thoughts. But with interest rates on investor loans in the 2 to 3s, that money is really cheap. For Matt Craner, some of the things that he said that are interesting, he talked about the personal financial statement. Now I've gotten in the habit, as some of my colleagues, of keeping it updated, semi-updated each year. I use a template that somebody gave me, and now I just update it a little bit each year. So I don't have to go through such a huge hassle when there is a property I like. If it is more than 4 doors, I just have to kind of tweak a few numbers and get it going. So having an updated personal financial statement and recognizing the value of folks who have these great things, like with Matt Craner at Westmark Credit Union, he's right there with underwriting. So you're not in this mystery zone of not quite knowing what's going on with your loan. If he has a question about whether something's going to fly, he literally goes next. I picture this, I'm making this up, but he walks to the office next door, asks the question, or he knows it already. And that is the kind of thing that you need to really make things fast and efficient. So you're working directly with the underwriter, and you're having access to those desktop appraisals for properties at about the million, but under the million mark. That's great. That's been crucial. So lending and financing is always a part of real estate, and it's been changing lately. And I really appreciate you guys to listen to what's going on in that. And thank you so much, Tyler and Matt Craner and Diana Hoff of Mountain West IRA for coming in to talk to us about this. I appreciate it. Any other questions on anything in the investing market, Linda?
Question for you landlords. When a tenant damages my property, does she have the right to repair it herself? Or do I have the right to insist that it be repaired professionally from my team of?
Who's the owner? Who's the owner?
Who's the owner? Well,
Are you talking like serious damage
I'm talking about doors that need to be replaced. This had been put through 2 doors.
Oh, yeah.
Well, I do too.
As the
She's
landlord.
walking in that.
So some of the ways that you might be able to get around a balking of a tenant who wants to do their own repairs is suggesting that you would want anyone working on your property to have a licensed contractor, a contractor registration. As long as you get the repair done and it was caused by her, you can indeed charge a deposit for that. That's a fair charge.
Charge her to take it out of the deposit.
If they cause damage to doors, even if she has offered to fix it, it's okay for you to insist that you want it done by a licensed, bonded, and insured contractor to avoid liability to yourself. And even though she offered to fix it, if it's not fixed, when you get in there, it's a security deposit charge. You just do have to make sure. This is one sometimes we get hung up on as landlords. You can't charge for the door damage, but then not fix the door damage. You have to have that receipt that says it was fixed and you can charge the
That's gonna
deposit.
be fixed.
Yeah.
That's not an issue.
Yeah, but so licensed and insured, there's some risk to having someone work on your property who's not a licensed and insured and bonded contractor. Yeah.
Does anybody know, is small claims court and eviction court, are they going or are they backlogged?
We were in eviction that,
In how long?
it was, just recently, it was squatter that were still. Purchased property and, the guy's daughter had been living in it for free for 3 years.
And we were able to get her to court quickly.
So Diana was just saying that they were able to do a quick eviction, or they're doing evictions right now, if that's not really come through.
Well, I'm thinking of doing a 3-day notice for her to pay for the repairs. And I will have my team do it. Or she can look elsewhere.
Do you have, all that covered in the lease?
It's not specifically spelled out.
Or
But that's certainly
access
above and
for
beyond.
repairs?
Yeah.
Normal wear and tear.
Mhm. Yeah. And you may have to wait till she moves out to get it done, but you can still charge the deposit. If she doesn't let you fix it on her watch, then fix it when she, have them schedule the day she moves out.
Does she have the right to keep me from fixing, sending people?
Well, is she moving out anyway? I don't think so, but isn't she on her way out, or is this damage that you're fixing
No,
mid-lease?
She wants to stay.
Oh, okay. Mm-hmm,
But we didn't know about it.
mm-hmm.
It's probably been a year or two.
Yeah, well, and that's the hard part. If they're kicking doors, how do we know they're not
They're
gonna
not
kick the new
having
ones?
right?
So it's actually rare to have that kind of thing fixed during the tenant's watch, depending on, it seems like they're either damaging the property. I'm just kind of thinking out loud, this isn't official advice, but they're either damaging the property and you want them out, or,
Well, it was her son that has done this and he has moved out. So I'm not fearful of more damage,
okay.
but I want the damage fixed
Yeah.
properly.
You can insist upon a licensed, bonded, and insured contractor doing the work
Thank you.
because you want it done right.
But on the other hand, because I just had this done at the beginning of the month, you can hang a great big mirror on it. I just had that done.
The old mirror on the door hack.
Yep.
Thank you, AVID investors. Thank you for those who tuned in. Have a great night.
Still,
Is there any?
Maybe she just.
And you had a chat.
Oh, is there chat?